Rob Arnott is the chairman of Research Affiliates. He's what was the expression that you had to describe yourself? The praise, yes. He's the head of dilettante studies for Research Affiliates University, and obviously an extremely well-known author on the topic that we're discussing today. Jason Zweig writes about all this stuff in the most beautiful language in finance. It's
a low bar, Larry.
Well, now that Peter Bernstein is no longer with us, it's become a lower bar, but you rise to the very top. And he, of course, works for the Wall Street Journal. And then Jeremy Siegel, I think, needs no introduction, but he is a Wharton professor and the author of Stocks for the Long Run, which I guess I should add sometimes yes and sometimes no, although mostly yes. Would you like to start, Jeremy?
Oh, I thought Rob was going to.
Whatever you want to do.
Oh, yeah. No, that Rob's, Rob and Jason.
Oh, your slides are up?
I've already paused.
Oh, okay.
Those two haven't.
You're absolutely right.
Yes.
All right. Can we get my slides up on the screen? Great. Well, firstly, Jeremy, last night I mentioned to you that statistics prove that you have high likelihood of living forever. And the proof of that is very simple. 80% of the people who have ever made it to age 80 in the history of mankind are alive today. 80%. Which means 80% of the people who've made it to 80 have not died. So, statistical evidence, the evidence is weaker for me because I'm 71 and it's only 60% for us. But your odds are getting better and better. I want to improve them considerably by creating a scenario in which we're going to have a chance for a repeat of this conversation exactly 10 years from tomorrow for your 90th birthday. And the way to do that is a very simple thing. I dare you to re-up on that bet. Now, in fairness, when we made that bet, I said we should announce it. You said, no, let's keep it quiet. And you announce it here after you won. That's naughty. So I dare you, let's do it again. It's for charity.
Let me think about.
Okay. I want your answer by the end of this session.
5%.
The 5%.
Cape adjusted.
Cape adjusted. Okay, I'll give you a little leeway. Let's make it 4.8.
We don't have that hole that we had before. That hole really gave me a big advantage.
So anyway, at the end of this hour, let's tell the whole group whether you're ready to re-up. Okay. Equity risk premium. This shows the graph that we've seen again and again, drawn in a different way. This is the total cumulative return on stocks relative to bonds. And you can see the first half of the 1800s, first half of the 19th century was really dismal for stocks. It was a horrible time to be in stocks. Bonds had good, respectable yields. Stocks, including Second Bank of the U.S., ignominiously went bust. And so there were a series of challenges leading up, of course, to the Civil War. At that point, things turned, and Jeannie Calment was the longest-lived human in history. She made it to 122 and 10 months, I think. Really, really impressive. She's an interesting woman, great sense of humor. She liked to attribute her longevity to tobacco and alcohol. She had one cigarette after breakfast every day and a little glass of brandy after dinner. she would not have lived long enough to see stocks beat bonds had she been born in 1802 and her parents put an endowment for her in the stock market. Had to wait till 1926. In fact, that level was tested again and again until 1949, 147 years later. You are absolutely right, Jeremy. We should pay no attention to data before 1871. In fact, let's pay no attention to data before 1949. Oh my God, look what happened then. Half a century in which stocks left you roughly 50 times as wealthy after 50 years as the bond investor. Absolutely stupendous. Pardon me. This half century started with an 8% dividend yield for stocks. It finished with a 1% dividend yield for stocks. That eightfold rise in valuation of the stock market relative to its dividend stream contributed a little over half of this entire excess return. So I think that's a special period of time that we should ignore in assessing the risk premium. Now, when we do that, we're left with a risk premium of a little under 1% per annum for 200 years. Do I believe that that's the normal risk premium for stocks? No, I do not. I think it's better than that, better than 0.5%. In fact, I'm even giving you 4.8 here, but never mind that. It's a host of special times, a host of special periods of time, and there are long periods of time when bonds beat stocks. The absence of spans longer than 30 years from 1900 to today, you can see in this ample history is in some ways a little bit of an accident. You'll recall that in early March of 2009, near the lows of the global financial crisis, I gave you a call and I said, Jeremy, do you realize that the long bond has beat the S&P 500 over the last 40 years? From February 1969 to February 2009? You remember your response? You said, that's impossible. Then you called me back the next day and you said, you're right. So,
I thought it took 40 years when the bond, was down to 1.
no, it was the low for the stock market, the
Oh, at the very bottom when the stock.
very bottom of the stock market. I would also hasten to say that that was not the same as a prediction on my part that the next 40 years was going to be a repeat of that. Hardly. I think starting conditions matter. One of the, I'm working on a paper called Revaluation Alpha. So much of our industry looks at factors and asks, did they work? You should ask the question, did they work net of revaluation? If a factor has gone from one level of relative valuation, the long relative to the short, or the factor long only factor relative to the market, to a much higher valuation level, then any extrapolation of that rate of return tacitly means you expect it to go higher and higher still. That's naive. Even a simplistic interpretation would be, okay, it's a new normal. Let's take that gain as it is, but let's not count on it going forward. Subtract out the revaluation alpha. This period of time, 1949 through 1999, is included in every update of Roger Ibbotson's SBBI work from day one. Well, not day one, because day one was halfway through that period, but has been in every issue of that. It's been more or less in every edition of your book, and it's instilled in the institutional memory of our industry, because one form of data mining is to keep looking at the same data over and over and over again, as if it's new data. It's not new data. It is a massive revaluation upward. Does that mean I predict a massive revaluation downward back to 8% yields. Heavens no. I just say take that eightfold rise in valuations out of the history and then ask the question, what's the risk premium? The residual risk premium that comes out of that is closer to 2%, not 5%. And there goes the equity risk premium puzzle, which has puzzled academic finance for a long time. Why is the risk premium 5% if theoretically people would only need tens of basis points to be willing to bear equity market risk? Well, there's your answer. It's not 5, it's considerably smaller. It's also time varying. If your starting point is 8% yield and bonds are yielding 2, I would say that from that point, a reasonable estimate of the risk premium would be huge. I would also say that from a starting point of a 1.1% yield, which we had in February of 2000 and which we have again today, you'd better expect a comparatively low risk premium. Now, today we also have relatively low bond yields, but the bond yields are the indicated long-term real yields based on long tips is north of 2. And so that suggests to me that you can reasonably expect 1% from dividends for stocks plus real growth. How much has the real growth been? 4% over the last 20 to 30 years, 2% over the last 100 years. So something in that range. That gives you a positive risk premium against 2% real yields on bonds, but not a large positive. The Shiller PE, and you are absolutely right, Jeremy, the Shiller PE was compromised when I made that bet because of the change in accounting rules. I had not taken that into account. And so you won that bet fair and square. The Shiller PE historically does a terrible job of predicting one-year returns. And every time it suggests caution, people point that out. And they say it does a terrible job. It's a useless way of forecasting. But look at the fit over subsequent 10-year returns. Look at the fit over subsequent 20 years returns. Then, I'm going to skip this in the interest of time, then look at the current situation. This shows the Shiller PE ratio on an inverted scale. It's a Shiller earnings yield. So it's the reciprocal of the Shiller PE ratio as the blue line, and the subsequent 10-year returns as the red line. Anyone who says the Shiller PE is a deeply flawed measure has some explaining to do. This fit is marvelous. It's a 73% correlation. That's as good as having a crystal ball that says 10 years from now, the S&P 500's return will have been X. Have that crystal ball, it's worth about 1.5 times as much as just looking at the Shiller PE. Now, the other thing that's noteworthy is in the 1800s, the U.S. was an emerging market, an emerging economy. It became the world's largest economy in the run-up to World War I, the world's dominant economy in the aftermath of World War I, and since. The evolution of the economy from an emerging economy to the most robust and powerful economy on the planet means a lowering of risk premia. A lowering of risk premia means a rise in valuation multiples, which we dare not project into the future as if it will continue into the future. Furthermore, greater longevity means that we have a longer horizon, hence the 10-year bet to assure that you're around 10 years hence to pay off. Greater longevity means we can tolerate a lower risk premium. If we can tolerate a lower risk premium, if a healthier and more reliable economy allows a lower risk premium, that allows higher valuation levels, and so the high valuation levels should not predict as low a return as it would have in the past. So this exhibit simply takes that trend line and detrends the blue line. you're still left with an adjusted um, Shiller earnings yield adjusted to take out that trend, which points in the direction of negative real returns on a 10-year basis. I am not predicting a negative real return. I am saying it's just as much of a possibility as it was in the late 90s. I'd also say, just as it was in the late 90s, picking the top is a fool's game. Thank you.
I'll go.
Yeah.
Why don't you go, Jeremy? I'll go.
I like alphabetical
When you were a kid, it always last, right? Always last.
All right. First of all, totally agree with Rob that the forward-looking equity premium is nowhere near the historical. I mean, I absolutely agree with Rob. I mean, it's logical. I mean, that, part of, we could argue what part of the equity premium is caused by the rising valuations, but that then distorts certainly what the true equity premium is upward. And I said that right away. I mean, on my data, I had something like 3.5% real equity premium. I'll talk about what I think it is future. It's a little lower if you take into Ed's a couple points lower on that. Rob, I don't understand what you mean 8-fold rise in valuation because the dividend yield went from 8% to 1%. That makes no sense to me. I know that we've had discussions in the past. You don't think repurchases mean anything. I've strenuously disagreed with that. I actually think most of the profession has strenuously disagreed with that. So I don't understand 8-fold rise in valuation. Before I talk about the equity premium, I want to talk about the Shiller CAPE ratio. Which Shiller CAPE ratio are we talking about? First of all, there are 3 incarnations of Shiller CAPE. First of all, it was always based on reported earnings, and we can talk about that in just a moment. And it was just the past 10 years of data, of earnings data to become the denominator. When Bob was told that, just a minute, firms are substituting repurchase for dividends, therefore there's an upward, price, right? I mean, repurchases raise the price, without question over time. Not at one time. Some people I'm amazed and confused. If a firm does a huge repurchase at one moment, it will not change the price, but over time. Certainly it does change the price. Well, then the slope changes, then your 10-year average changes. Bob recognized that, or at least was convinced by those that were putting it, so he had what was called the total return CAPE. When the total return CAPE didn't work, Bob went to the excess return CAPE. Did it remind you of the ancient astronomers putting epicycles on the orbits to explain the movement of the planets? Yes, the Earth was the center of the universe, and the reason why the planets had this strange thing there. We have the epicycle theory. So then you were very dismayed. Am I correct, Rob? When he did that, Rob, you emailed me and said, "Oh my God, he's defaulting to the old Fed model." Yes, well, I have the email. So. Yes, you did not like the excess return at all. Did you? I would still think you're against that. You should be against that.
I believe you. It's just the Alzheimer's is speaking.
Oh, I don't know. I'm 9 years older than you. I shouldn't have that. No, yes, you were very. I remember when all of a sudden the ECY excess return yield was there. You came to me and said, "Oh God, he's succumbing to the old Fed model," which used to, remember, it was dumb too. It was compared to nominal return on bonds to stocks and all the rest. Then it fell apart because it also had some misunderstandings there. So then there's those three that he rotated to, and then there's the whole question of whether we should use reported earnings or operating earnings. This is a deal here because as you admit, the reason you lost the first one was the difference between the two, actually. I mean, there's a huge difference between the two. Now, operating earnings are not perfect. Operating earnings, however, are much better than they used to be. They really do expense the options, and we can go, in fact, and I have a chapter in my book that goes through what's in reported earnings, what's out, what's in operating earnings, what's out, how things have changed over time. But let me make the following strong statement. Reported earnings upon which you want to make that basis have now been rendered by FASB as virtually worthless. The perception that you put capital gains and losses into a yearly statement of earnings is a statement that Warren Buffett said was the worst accounting decision ever made, and which he said vendors reported earnings as worthless. And the response is no one cares about them, and no one does looks at them. Maybe some year, maybe some decade, maybe some century, they will. But that's their fault. Their accountants are a little confused on a few things, and that was one of them. He said that capital gains and losses don't give you an ongoing look at what actually is happening to the company, and therefore that's one of the reasons why. So now you have operating earnings versus reported earnings, old-fashioned CAPE versus buyback enhanced, or what do you call the total return CAPE. So you're going to have to make a decision exactly on the what buybacks were. You just did total return rather than just the price return. So he added in the dividend, which I actually think was a big improvement. The move that he made to the excess return was very weird. It made sense to a lot of people because a lot of people say that's the equity risk premium and that's what should revert back. But I remember early on talking to Bob, and I said, when you put all your ratios and on your long-term graphs and on, he was really wonderful at free data on the internet. He never charged. He updated it continuously. And I said, you never had the interest rate on it. And he said, because I never thought the interest rate really mattered for the CAPE ratio. It was interesting then he defaulted on that. He defaulted on that probably because the CAPE ratio in standard form was not doing a good job. Now, Rob, you do show those regressions. You did 10 years ago, you did 15 years ago, 20 years ago. The question is, have they served the investing public well? And the answer is not really. Because had we been looking at those, you would have been, and everyone would have been, grossly underinvested in stocks from the financial crisis onward, because the CAPE ratio has been above its long-term mean for 99% of the months over the last 20 years.
or 18 years, and you would have been getting the wrong signal there. So it's more than saying it's just not a good indicator for 1 year hence or maybe 5 years hence. It is not been a good indicator. I'm pleased that you now think, let me give you my projection on equity premiums going forward, that could be higher. All right, we take a forward looking right now. I'm not going to do any cyclical adjustment. Let's just take the data. You get a 23 or something like that, 22, you could 12-month forward, and that gives you maybe a 4.5% real return on equity. You said north of 2 for tips. Not quite sure because 10-year tips are 1.8. 30-year tips I'm not as trustworthy with. First of all, tips do lag. There's a question of there's risk in terms of changing the index there. You might not argue that it is far. Also, and I know we're talking non-taxable, but we both agree that tips have terrible tax implications that stocks do not have. So, that would lower that even more. But let me buy the 2, which I think is giving something up. And let me say that if I take the 23 forward with no reversion back, but it also means that all the growth stocks revert to the same growth rate of earnings that the rest of the market, and none of those projections, go forward. And it stays at this PE ratio for whatever reasons you're projecting 4.5. So that's a 2.5% equity risk premium, much lower certainly than historical. And that would be the projection. You believe that there's going to be some mean reversion back. I say 20. I think it's below 20 X tech. I think no one could, how AI could change the world and change earnings. We haven't discussed that. What is the potential here? I think it's a greater discovery than the internet that powered the 2000 bull market. And clearly the people that utilize it first are going to have huge profits. We know in a competitive system, some of those will be competed away, of course, later. So we would have to factor some factors in. That's very, very difficult, and it would be a great topic of conversation to be without saying the least. So, my projection is we probably have a 4.5%, maybe a little bit higher, 4.5 to 5 on real on the stocks, and 2% on the tips. That would be a 2.5% risk premium going forward, which over 30 years, if you do the math, still accumulates to an awful lot of difference. I just want to comment on your very first. Could I just take a look? Can I go back and take a look at that? So we're looking at this graph from, the 2009 low. I mean, that slope. And even if we go from this peak to here, that's not bad. I mean, you sort of say like it stopped in 99, and as I pointed out with NASDAQ, had you held NASDAQ from that peak to the present, you had a 7-8% nominal return. I didn't do the real part. That's just not bad either. So, going from this tip over here up to where it is today, I don't think like the story of equity outperformance ends at that point. Anyway, thank you.
So I'm hearing that we have a bet at 4.5 real, no cape adjustment.
That's correct.
Yeah, I was counting on seeing fur flying all over the place. Well, I think, Jason,
Did I just make a move?
You just did.
Oh, I did? Oh. 4.5%
Real.
with the cape adjustment? Or
No cape adjustment.
Oh, I'm sorry. I didn't know that.
You dispensed with cape. You said cape is just a bad measure. So I must.
I'm betting with you because you think it's a good measure. Now you're
Okay, with or without the
you're
cape.
talking 4.5. No. Why would I bet on something that's expected value?
Well, that's true, but you said 4.5 may be better.
Well, I said, yeah, and maybe worse. I
So-
give you an example.
Please use the microphone. So do you want with or without the CAPE adjustment?
It took me,
Okay, now.
Rob, it took me a week to make the first bet. I wasn't sure what I was. So, we'll talk about the sex. The set. By the way, a year and a half ago, you made that offer at 4.5% CAPE adjust. I should have taken that. Because the market was much lower at that point. Okay, so I have to think. I didn't take that. So no bet at this point.
Now, boys,
No bet. I'm not expecting. I worked out that I thought I had an EV of about 90% on the first. Okay, I'm not going to take it at 50%. I'm too risky. I'm giving you a norm.
as a non-participating neutral observer of the market, Jason Zweig is going to figure all this out right now.
I'm going to skip going to the podium because I don't have slides, and I'm just going to share a few thoughts off the top of my head. First of all, Rob mentioned the French woman Jean Calment, who died at the age of 122. Some years ago, I read an extensive article about her, and there's an anecdote you might not have heard, Rob, that I think I'll share because it will cheer Jeremy up. At her 115th birthday, a French journalist attended and later wrote up the interview. And it was a very nice birthday party. And as the journalist was leaving the house, she thought to herself, well, what do you say when you walk out of somebody's 115th birthday party? And she thought about it for a while, and she went up to Madame Calment and she said, well, I guess I'll see you again the same time next year. And Madame Calment said, without missing a beat, well, I don't see why not. You seem to be in perfectly good health. So I grew up in the art and antiques business, and I spent most of my childhood, most of the spare moments of my childhood, going around the backwaters of New England with my parents, visiting antique shows and auctions, and sort of getting an intimate look at 18th and 19th century colonial and federal American history. And I grew up handling a lot of artifacts of the earliest American corporations, including a whole bunch of stock certificates, which my parents never bought because they said they were worthless, and most of them were. And that gave me, when I finally became a financial journalist, a really keen sense of survivorship bias. And, we know about the Bank of New York. Nobody knows about the Snickers Gap Turnpike Company. And I don't believe that it is even in Ed's database. And if you look at the book that I think is still regarded as the definitive history of earliest corporate America, Joseph Stancliffe Davis's book, he mentions in that book that in the year 1800, there were 300 joint stock companies in the United States. Real people put real money into those companies, and there's no historical record of their performance. The companies, I would estimate over 90% of them disappeared without a trace. Almost every town in New England and Pennsylvania had wooden turnpikes, and many of them were connected by canals. Later, there were stagecoach companies. And what's fascinating is all of these transitions provided the fuel for the Industrial Revolution, but the progress of corporations was built on the corpses of the companies that had come before them. And so, for example, when the telegraph was invented, a lot of the telegraph lines went on the abandoned pathways that were built for wooden turnpikes that had been out of use for 20 or 30 years at that point. So I think the early history, the 19th century history, is really problematic because even when we expand the data set, as Ed has done so beautifully, we're still left with a very incomplete set of data. And, you know, if you read Mark Twain's autobiography or his book Roughing It, he talks about his days, in the Wildcat silver mines in Nevada. And there was a Virginia City Stock Exchange. In New York City, there was something called the New York Petroleum Exchange, which I believe had, if I remember right, in the 1860s had a total market cap of something like $60 million, which in today's dollars is enormous. Gone. It's just erased from history. We have no visibility on it. And did the typical or modal American investor own Western Union, Union Pacific Railway, Pacific Mail, or did the typical person own shares in, the local community bank or some other tiny transportation company that went out of business without a trace? We don't really know. But there's one thing I am confident about in the 20th century data, which is if we fast forward and let's say we start counting in 1926, I would argue that total return is a technology. And it was invented, and Roger alluded to this, it was invented maybe in the 1960s, and it didn't become practical until the 1970s. Nobody, and I mean nobody, reinvested dividends. No individual investor, certainly. People lived off their dividends. And arguably, most institutions probably didn't reinvest their dividends either. If they did, they certainly didn't reinvest them into the cap-weighted basket that they came from, because the technology did not exist. You couldn't do it. And it wasn't until the invention of the index fund, in the early 70s, and then the popularization of it in the mid-70s and 80s into the 90s, that total return became practical for everyday investors. So I think we should have a very bounded view of what the history means. In theory, these numbers are useful, and obviously we need them when we're thinking about forming expectations for the future. But are they a realistic reflection of what investors actually got in the past? I would argue utterly not. They probably bear almost no resemblance to what people got in the past. And I spent a couple of months, I think it was during COVID actually, doing pretty intensive research on what we can glean about the history of dividend reinvestment in the 20th century. And if you look in the Fed data, there's also a bunch of NBER reports that were published in the 40s and 50s. there's almost no trace of people reinvesting dividends. They spend it. Nobody in 1929 to 1945 was putting dividends back into the stock market. They needed the dividends to pay their grocery bills. And, you know, in my role as a journalist, as somebody who interacts with investors in the real world, those are the messages that I try to convey to people, is that, you know, the data about the past can inform your view about what the future might be like, but they don't really indicate what the past was like. And that's a difficult leap for a lot of people to make. And, you know, one of the hardest lessons that has taken me the longest to learn, and I've been a financial journalist for decades, is that everything that any of us write and publish it's a palimpsest. And if anybody in the room isn't familiar with that word, it's a wonderful word that was used in ancient Greece to describe a manuscript over which people would write their own document. Because, of course, in ancient and medieval times, writing materials were rare and expensive. Paper wasn't really manufactured. People wrote on animal skin or clay or whatever other material they had, and they reused things. And so when any of us write, what we publish is a palimpsest. And most people who read it in conjunction with their own confirmation bias. And therefore, if they're inclined to believe in stocks for the long run, when they read Jeremy's work, they see it as proof of what they already believe. If they're in Ed's camp or Rob's camp, they read what those gentlemen write, and it proves what they themselves believe. And one of the dangers that we get into when we communicate with the public is forgetting that when we present the evidence that we've gathered, that people are going to do with it what they will. And Ed alluded to this earlier when he talked about the bottom half of your readers. But I would argue it's not the bottom half, it's everyone. And, you know, it's very easy for nuance to get lost. And I think all of us should respect the fact that we have to make bounded claims, because black and white statements can be misused and misconstrued by probably most of our readers. And the more cautious and less judgmental we can be, the better. And I'm not always innocent of that, but.
Can I just second that? That was very good. You know, Jason, you were saying exactly what I said. People might have thought the indexes were giving 6.5%, or less before 1871, according to Ed. But here in 1871, no one was getting that. I mean, you weren't getting that, and certainly you were getting at a much higher risk, because you couldn't diversify the way that you could there. You know, as I said, you're lucky to get 5. So 5 today is 20 if you assume that, that's just a PE equivalence in terms of that. And that's why I think since the index fund, things have absolutely changed and gone up. And that will lead to lower, just like on the run bonds have lower yields than off the run bonds. The more liquid have less yield than the less liquid. That's one of the fundamental precepts of finance. The more liquid stocks are, and they are never been more liquid, the less forward-looking return you're going to get.
Yeah, and just to add one quick thought to that, Jeremy, I mean, the other thing is that the frictional costs of investing were insane in the 19th century
Oh.
and even into the 20th century.
Oh, yeah.
I bought my first stock in 1976. And a few years ago, I went back. I actually found my old confirm from the stockbroker because my mom never threw anything out. And my round trip trading costs were 7%.
Well, fixed commissions were extremely high.
Yeah.
And,
And by the way, it was a very good trade. And I made plenty of money even afterwards. I'm sorry, Larry.
What was the stock?
It was McAndrews and Forbes, which became Ron Perlman's takeover
I
vehicle.
want to follow up on one thing about companies that go out of business. You talked about earlier. Do you know what one of the best performing stocks in the original CRISP index from 1926 to the present is? Thatcher Glass Company. Do you know what they did? Glass bottles for milk. Totally disappeared, but was, eventually bought by Philip Morris and, and it kept on, and then you accumulated in other companies that had nothing to do with the original and made a fortune later on. That's what I learned by going through the CRISP data set from the 1926 companies that went out of business. Well, they didn't produce anymore, but you made a tremendous amount of money. So you can't just talk about the company going under. What did it become? Who bought it up? And you have their shares. That's it.
Jeremy has done brilliant work on company successions. I had the privilege of accepting your paper on the original S&P 500.
Oh, you like that.
And tracking.
You
Oh, I
know
love
Rob.
that paper.
I have a comment. For
Yeah,
you,
what happened to the
Jason.
original S&P 500? And we did an update. There's Jeremy Schwartz in the room. Yeah, there's my the global COO of Wisdom Tree, where I'm a chief economist too, and he was my research assistant and did work on that. We've updated that. The question is, the original 500 S&P companies that were 1953, if you just held those original, well, no updating, there have been 2,000 companies added there, your return would have been the same or even slightly higher than an index fund in the S&P 500.
I think it was about 0.5% higher.
It was higher
Higher
there,
than.
but now it
Now
isn't
it's-
because of the Mag 7, basically. So now I think it falls behind by maybe 10 basis points or something like. But it's absolutely astounding because so many people tell the story. Oh, the only way you do so well in the S&P is because it's continuing upweighted with new companies. It turns out these old companies that sold at 10, 12, 13, 14 PE accumulated return far better than the others. I mean, I started my book with the story between Standard Oil of New Jersey and IBM and earnings growth and all that. It had to do with valuation. Valuation in the long run is far more powerful as a wealth creator than growth. Growth is great in the short run, medium run. In the long run, the valuations, if you do the data, are overwhelming.
I think the other Siegel needs a little chance to talk.
Oh,
we're going to open this.
Yeah,
That's a
you
question.
need to talk. Yeah,
Is this on? Yeah, I have a question for you, Jason. Everything you said, I agree with everything you said, except the implication. Just because it was technologically impossible or difficult to reinvest dividends in any sort of efficient way, or because people spent the dividends because they needed the money, that doesn't mean the corporations didn't spin off the return that is represented by the total return index. They did. And so if we're trying to figure out what the economy, what the corporate sector of the economy is capable of generating for investors today, I think total return is exactly the right measure to use.
Yeah, no,
Do you agree?
Yeah, I mean, I think, thanks, Rob. I think all I was really saying is that there are two levels of analysis, right? One, there's macro and there's micro. At the micro level, at the individual level, people weren't getting those pay. They weren't reinvesting the payouts, so they weren't earning they weren't compounding at the reinvestment rate. But for the economy as a whole, absolutely.
That they were getting the returns as milk and record players, and airplane tickets.
But it was a consumption
Right,
return.
right.
We should also mention, in my opinion, and because Rob, we're all concerned about why is the dividend rate so small and why is reinvestment so high. It has a lot to do with the U.S. tax system, which is most dividend unfriendly of almost any in the world. I remember I was on a George Bush tax advisory program, and I was asked about what we should do with that, and I said, if you reinvest your dividends, it should be tax-free until you sell the stock, just like what happens under repurchase. And that would put the two on equality, and you will see dividends go up as a result of that. It was, in fact, for the Republicans, actually, there were several bills the Republicans put forward on that issue. It never got to a vote. And I guess Trump was not excited about it or didn't hear about it. It sort of has died as a legislative procedure. But if you want to increase dividends, you got to reduce the taxes and put it on par with the repurchase. So one of the reasons why dividends have gone down so much, not the only one, but one of the reasons that dividends have gone down so much is exactly that tax issue.
Ed McQuarrie would like a word, and then then we'll open it up.
We need a mic.
But getting that, I'm going to also numbers.
Please wait for the mic.
1.2% is the dividend yield on the S&P 500. 1.6% is the share buyback yield, for a total of 2.8.
I'll push back aggressively on
no,
adding
that's
the two.
That's not correct. No, that's just not right. Okay.
What is right, Jeremy?
No, the repurchase rate is much. I mean, look, just think of this. If let's say 20 times earnings, that means you're earning 5%. If you're paying 1%, you have a 4% buyback. If at 20 PE ratio and you have a 1% dividend, all right, you have a 4 percentage point buyback. Okay, so the PE is 23. So the buyback is maybe 3.6 or something. I'm just telling you what the data is, right? I mean, that equality has to hold, isn't it? I don't know. You guys are in finance here.
Retained
Roger,
earnings.
isn't that a logical proposition?
You're ignoring retained earnings.
Yeah.
You are.
Well,
First of all,
No, I mean,
you're violating Miller and Modigliani. And
you can't.
but just in general, from a tax perspective, they did under Bush. Of course, they did change the dividend taxes. It used to be taxed at ordinary rates.
But they lowered, but they never lowered it enough.
to the capital gains rate, and that is actually an appropriate thing to do because
No, it isn't,
because
because it's, the
when you
timing
pay
is
it-
wrong, Roger.
when you pay it out, you've basically paid the capital gain, and now the value is that much less. So all the money you're earning is basically at the capital
It's
gains
not.
rate.
It's
And
not
also-
equivalent. It's
Also,
not an equivalent at
but-
all.
but the capital gains rate, if you do hold it on, of course, it's deferred.
Oh,
Whereas the dividend is
and
not.
that's so
But it's basically
unbelievably
they're both
important.
being taxed at the capital gains rate.
Yeah, but
Seems
that
like a
deferral is
Totally
that's
appropriate thing
it.
to do.
That deferral is it.
And it was.
I
at the
wouldn't call it
ordinary rate.
equivalent by any stretch of the imagination.
It's totally equivalent.
I have a
It's totally
suggestion,
not
if I
equivalent.
may. I think we're at the time for the overall panel. Why don't we get everybody up here, grab a chair,
Well, I think Ed's been waiting to say something.
but he'd
Then
be
we'll
coming
do
up
that.
and there he gets the first. Grab a chair. Or take
Oh,
this.
no, let me stand for a bit. So, nothing about taxes, just back to what Jason said about dividends. Okay. Now, I do think it's true that dividend reinvestment did not occur. So the question becomes, we're sort of missing a panelist here, and that would be Hendrik Bessenbinder, okay, who's has a recent FAJ article in terms of if we had to relax this assumption about unrealistic assumption about dividend reinvestment, what alternative measures of total return could we have? And I'll be looking to try that in some of the early 19th century data. What I can say from already done research is I have a mutual fund returns database from 1926. So I know what happened if you did reinvest the dividends, but you paid all those transactions costs, which fortunately were not quite 7% on there. And basically, if you were a mutual fund investor, you lagged the S&P 90 by about 150 basis points, 1926 to 1986. And of course, the problem with compound math over multi-decades or a century is, the dollar wealth at the end when you subtract 150 basis points. Oh my God.
I want to respond to all these dividend discussions.
Roger, why don't you come up and we're going to have the full the full Monty here. So if you want to be the first,
The movie was about.
it was my idea of a joke. I never said I was a comedian.
It's a British movie. Show it, Elroy.
Hi, everybody. Welcome to the round robin section of our afternoon. We have the QR code on scattered around the room if you want to send a question up that I'll get here. I've got one or two, but I don't have many, so please feel free. My name is Amy Resnick. I am the executive editor of Chief Investment Officer and Plan Sponsor magazines, and I'm thrilled to be here and a little intimidated by the brain power on this panel. But I'm going to start out with a question for the audience. We want to see a show of hands of who in the room, after hearing this afternoon's discussion, expects equities to exceed bonds by a negative equity risk premium or by a 1 to, I think that's 1.9, or small equity risk premium, or by greater than 2 at equity risk premium of 2. So we'll start with the first subset of a small premium of around 0. I was not given a range, Carl.
And it is arithmetic or geometric?
Geometric at its long run.
What's the geometric?
Yeah, give it 10 years.
10 years geometric. I'm not going to argue with this
What's,
group.
what's the first range? Negative? You're saying a negative risk
A negative, so less than 0.
Below 2, positive 2%?
No, one's looking for
0 or less.
0 to 2.
Or, right.
Okay, let's.
0 to 2 to 4, 4 to.
Okay.
Okay. I was given 3 options to ask about, but we can go higher if people want to go higher. But 0 or less.
10 years.
Okay, we've got about 3, including Ed. 0 to just less than 2. Okay, that's a popular choice. I'm going to say a little over a dozen. And then greater, 2 or greater.
No, 2 or 4. 2 to 4.
2 to 4? Seems pretty close. Well, more of the panel for sure. 4 or over. Nope, just Roger. Oh, and 1 over there. 2 over there. Sorry. All right. So, well, we know where the optimists are sitting.
Tell us totals now for groups.
I believe the 2 middle choices, the 0 to just less than 2 and 2 to 4, were the biggest groups. There was a smaller percentage of 4 and over than there was of negative or less, 0 or less. No, there were 3.
3. There were 3. There were 3. I can. That's the best question yet.
I have one question that is just my question for the panel, because we've had a lot of discussion about the quality of data, the different data sets, where conclusions can be drawn or can't be drawn from different kinds of data. And we're in a period where the economic data coming out of this coming from the federal government is, first of all, has been delayed by the shutdown, and we don't know who's going to be running the Bureau of Labor Statistics. Is anyone on the panel concerned about either the politicization of data or the availability of quality, reliable data going forward?
I think my answer would have been yes through multiple regimes over multiple decades.
Okay.
It's always politicized.
Well, I think this is, I was on CNBC a number of times on this question. And I said it's a scandal that the BLS they send out these questionnaires and say it'd be nice if you filled them out in 2 weeks or 3 weeks. I think there should be mandatory filling out of these. And the previous commissioner wasn't, not saying the new one will. It had always been my recommendation. It's sort of like, we're sending them out in August, and, I know you go to the beach, so, try to get it back, but if you, don't get it back until September, then we'll get it in a revision sometime later. I mean, this is inexcusable. It's too important for that.
Jeremy, if I could add to that, I actually think that maybe surveys are not the way to go. We're living in a world where I hope that technology helps us to determine how
Paper
many
surveys.
people have, right, because the response rate has been coming down dramatically. And
It went down during COVID. You're so right. It was down during COVID. Everyone said, oh, it's going to come back up during COVID. And it didn't. It kept on going down. Do you know what the response rate to the important JOLTS data is? Something like 23%. It's unbelievable. This is a data point that, Chairman Powell has quoted continuously during his testimonies and his, press conferences. And there's almost no one responding to it anymore.
but Jeremy, and I would add that that's not a political issue. It really is one of technology. You have not been able to find a way of capturing this data of how many jobs are being created or how many posts are there. There has to be other alternative sources that are more reliable. And I think that needs to be an investment if you want to make good decisions, because surveys, who wants to answer a survey nowadays? I mean, one person. I mean, I really don't. What I would say is the following. I mean, I don't know if you look at the University of Michigan consumer confidence, and there was a remarkable drop on the confidence level since you switched from, calling someone up, how are you feeling about the economy and your jobs, versus filling it out online. It seems like the people who answer these surveys online are going on rants. Only the people who are pessimistic about the economy, are not confident about the economy, have actually answered these questions. And so you see a dramatic decline on consumer confidence from the Michigan. And precisely, just surveys maybe cannot be the only indicator on how you measure what the economy is doing.
I'll give an example of when I said everything is political and all things are politicized. The Michigan survey, they did an analysis of it, and it's about folks who answer it are about 80% Democrat. So Democrats are pessimistic. Trump's in office. Is there a connection? Just maybe.
I understand, but you see, regardless Democrats or not, like you see that big drop when you switch from, because people are afraid. If I called April and I said, how are you feeling? Do you have a job? How do you feel about inflation? And I call you up on the phone, maybe you're a little bit more reluctant. I'm not going to ask you to be very negative, right? If you answer like online, you're probably going to say, no, this is all wrong. And I'm going to be like, I'm just saying there's also a bias of just how the survey is being conducted, as an example.
Always. There's a comment down here at the end. No, no, you. Sorry.
Yes, you can hear me. Two answers to that. One is that most of what we've been talking about today is from market data or data that are reported by corporations about the earnings. So I take some comfort in the fact that we're not desperately relying on estimating the equity premium from bad government data. So in some sense, let's get what we can out of the market. The second thing is we've been conducting Bob Schiller's monthly survey of investor confidence, and we send it out by mail to a bunch of people. And we, the response rate fluctuates and has declined over time. But I will say that we send it out to both institutional investors and to high net worth individuals. And those two series are relatively correlated to each other. And more interestingly, they're correlated to market indicators of measures of things like risk and so forth. So I'm somewhat surprised at the fact that we're actually able to glean things from a mailing survey to begin with. And so, surveys are samples, and it's a sampling process. As Rob says, look, if it's a biased sample, then you have to really worry. But I'm not in a panic yet about the fact that the government's not delivering on these macro variables.
Jeremy, looked like you had something to say.
Well, there has been this search for alternative data. I mean, we had ADP data. They went to weekly now from the monthly data that came out on the Wednesday before the report. There's several other services that have been estimating data. Now, the CPI is more complicated, and real data really depends on that CPI because Social Security and indexing becomes on the CCI. But there are price that I mean, given the internet and all that, there is the Million Price. Isn't there the MIT project called the Million Price Project or something like that? Which I don't know if it's ever been trying to make an inflation index out of or not. But I mean, there could be alternative private ways to get there. But until we're there, I'm not one for forcing people to do things, but to put it down, if you use the carrot or the stick, you can either fine them or give them something if they do it. I don't care. But I mean, there's certain data, and that employment data is acknowledged generally by the market as the single most important indicator, monthly indicator. We've got to give people more incentive to get it on time. It's not difficult in the age of the internet to do that, and it wasn't done by the previous commissioner of BLS, and then so the frustration built in on that. I do want to say one thing, that just to correct this thing about buybacks. I was holding leverage constant. If you earn 5%, you can say, "Oh, I can do retained earnings. I can buy Treasury bills." That's changing your leverage. So, or I can reduce my debt with that money and not buy it back. That's also changing the leverage. So if you have that 5%, you keep the leverage constant. We can talk about how you can do it in a growth. You could do it also in a growth sense. Then it has to be a buyback. If you're going to give 1%, have 5%, keeping your leverage constant, you have to have the 4% buyback to stay in equilibrium over time. So, I mean, I just wanted to point that out. I didn't make that point before.
Okay, Elroy, and then the audience took me seriously, so we have a good number of questions, and there's one at least in person.
I guess I'd like to add in something which is a sort of change of direction a bit. We don't know what the equity premium was. We're not much clearer now than we were years ago. But the products that are selling us factor exposure, small cap versus large cap, value versus growth, and so forth, they are burgeoning. There are an enormous number of factors and indexes compared to the number of stocks. So we really ought to be thinking a bit about the different premium. Oh, no. You look especially.
Yeah, I mean, we have John Cocker's The Factors Do
That is a recognition of this problem.
But there are not as many animals in the zoo as stock.
The number of indexes that are produced is far larger than the number of stocks.
But the number of factors is still
When I was working with
uh,
when I was working with FTSE, they were tracking 2.6 million indexes
Well,
under contract for.
Yeah.
appears basically a combination of thought you can use a seats the
So
but I'm talking about you better recognize factors. Quality, this, that, and you got those are the factors.
come here, stop feeling.
Jan Falcon said there were
big-
400.
The big issue is what you expect to be rewarded for. We don't really know whether we can expect to be rewarded for equity risk compared to just sticking the money into a vanilla zero risk asset. And now we've got an enormous number of people who are taking investment decisions on the performance of different sorts of exposures, whether it's indexes or anything else. It's very, very puzzling that we've got into that decision. In that position.
And Elroy, just to one thing that I also worry about is, of course, you have seen the rise of private capital, right? And we are making all of these investment decisions more and more on fewer companies being traded, right? The number of companies, both in the US, in the UK, right, have declined significantly. And so even when you're looking at factor models, for example, I wonder that the size effect, for example, a lot of private companies that are small, they stay longer because of venture capital, private equity, even corporate investment. They stay longer private. By the time you are a Meta and you come and become public and you are the success, because we're not learning about all the failures, they come at a much higher level if you think about deciles, for example, right? And so you're no longer a small company. You are going to miss all of the return from being a small company to a large company because it's private. You don't have that information. So what I worry is that we're going to have less and less market-based information unless you start measuring some of those private investments that, the ones that fail and the ones that made it to be very big and being a Meta, Facebook kind of thing.
The only thing there is to encourage firms to go private. And obviously, we know that, Sarbanes-Oxley and all those restrictions, plus others, have made it difficult for firms to go private, undesirable for firms to go, public, excuse me, you're right, public, and undesirable for firms to go public. And we need to encourage firms to go public. We need to give incentives for firms to go public. Instead of it, it's the other way around. The incentives are for firms to stay private. And that's gives you a problem that you're talking about, Carla.
It's
Right.
it's not the fault of Sarbanes-Oxley because this is a worldwide trend.
Phenomenon.
Yeah, the number.
Well, but I
of
think some of the
names-
same trends are in progress. You need to divulge this and this and that. I mean, it's an interesting thing. I mean, I have to say, there's a lot of things I don't like about Trump, but this thing about going to 6-month earnings reports versus quarterly reports, just to ease that burden, actually has some positive features to it. I mean, as long as it's not mandatory. I mean, are we concentrating too much on making the quarterly numbers? What are they really telling the people? How much effort is really being put into that? And now it's mandated, and that seems.
Let AI do it.
What?
Let AI do it. Let the AI do the
if-
finished report.
That's okay. Well, then that's another issue. That AI put on then the AI can replace maybe half the firm, right?
I'll be mildly
we have a question
provocative.
on this.
As a libertarian, I like the idea of less and less regulation. And so I want to see annual reports. I don't care about quarterly. I don't care about semi-annual. You want to take the time to put out a weekly report, go for it. Quarterly, go for it. Semi-annual, go for it. Mandatory for 1 year for annual.
Yeah, I mean, even that might be good. Not even 6 months. So you want to go further than Trump on that?
So back on the factors, because regulation we're not going to solve here, but the people that are making investment decisions really need to have some guidance about whether or not these rotations of publicly traded securities have prospects for adding incremental return. The more there are, the more difficult it's going to be to do that. But more importantly, as the movement towards 401, getting private equity into 401k, the argument for it is that we've lost exposure to profitable factors because of these constraints by regulation, and so therefore investors should be given the opportunity to capture those factor exposures that they hadn't had before. On the other hand, there are all the arguments against it having to do with expenses and difficulties and fairness and adverse selection and so forth. But I think it's a really important question for the people that are making these advising investors about, how much do the publicly traded securities span the space of productive in factors, or do you really have to augment your portfolio in order to capture things that once you could capture in the public market? I don't. It's hard to answer that because the private markets are just, the data's bad. But I think we need to keep trying to do that.
Well, I thought the first part of your question, and it relates to Elroy's question, as you know, I'm associated with a firm, and Rob owns a firm that basically has a value tilt, and it's been difficult in this. I mean, it's unprecedented, the growth versus value of the last 15 years. We haven't seen it in the 100 years of Chris Bata ever, and I do want Rob to speak about this. We have just never seen that. I mean, Warren Buffett is a hero to many, value investor. In the long run, the data certainly seemed in the mid-20 teens that in the long run you profited by that value tilt. You have not profited by that value tilt, and that's become difficult. Rob, could you comment on that?
Yeah. Here's the fascinating thing. I wrote the FAJ paper, Reports of Value's Death Have Been Greatly Exaggerated, in early 21. And the point of that paper was that the underperformance of value, well pronounced, was entirely due to falling relative valuation multiples. The gap in valuation between growth and value was getting wider and wider. And absent that, if the relative valuations had remained the same, the relative PE ratios or price to book or price to sales, if those relative valuation ratios had stayed the same, value would have eked out a win. Not a big win, but a win. And that was over the span from 2007 to 2020, which was the span of the value meltdown. Since then, we've been bottom bouncing. It hasn't gotten worse, but we've been bottom bouncing. And so this is part of the issue of the revaluation alpha I was alluding to earlier. The entire underperformance of value during this horrific value rout has been negative revaluation alpha.
It's very sensitive to those time periods. After the dot-com crash, growth got way undervalued. As much as it was way overvalued in 2000, it got way undervalued 2003 and 4. So it's been a combination of revaluation and better earnings. You're saying from that time period, it actually happened to be the valuation point.
And this century today,
rather than the earnings point. I mean, more recently, there's no question the Mag 7 earnings have been much better than the value stocks. I mean, over the last 5 years.
But century to date, the growth in earnings for Russell 1000 value has been 0.5% below the growth in earnings of Russell 1000 growth. Over a quarter century, just 0.5% a year. That's a 12% difference in cumulative growth in earnings in favor of the growth stocks. That's all. And when it comes to dividends, it's 1% per annum the other direction. Of course, people will dismiss that because Mag 7s don't generally pay
But the
dividends.
Mag 7 phenomenon lasts, 5 years, really. Not, I mean,
It
I
is.
know it's good to go back 25,
And-
but you have to face 5 years.
Yeah.
And, that's really difficult. And to get people, further, we give 5-year past projections and most 3 to 5 year forward projections. And people are saying, yeah, but it was like no, back then there was no Mag 7. I mean, or
Show of
virtually
hands. How many people here have seen the film The Magnificent Seven? How many of the 7 are dead at the end of the film? Come on, shout out the answer. All right, 4. So, so my point isn't that 4 of these 7 companies are going to keel over and die. My point is that they're all priced as if they're going to be spectacular
just a
winners, and
minute.
they won't all be.
You only need, if you buy 10 lottery tickets, you only need 1 winner. Come on, Rob. You can't say something
is-
like this. You're not
That sounds
better
more
than
like venture
that.
capital than
Rob,
than
come
public
on.
equities.
That's absolutely true. The 2010s, the 10 most valuable companies on the planet in 2010, only 2 were still on the list 10 years later. Those 2 were Apple and Microsoft. So the top 10,
Yes, so you
Both
still
performed-
became a winner.
right.
Okay, I'm going to jump in here and see if we can get some of these audience questions answered. No offense to anyone on the panel. So to follow on some of what has been just recently discussed, how do you account for the impact of AI with the issues that have been discussed today, and where do you see it in the future? And whether it's regarding valuations, whether it's regarding producing data, it's come up a couple of different times. Does anybody have any thoughts they want to?
I have questions I think about this because I think about, first of all, I look at estimates that how much AI is really going to contribute to productivity growth and real GDP growth. And there are some papers out there, namely one from one of the Nobel Prize winners in economics this year, Philippe, sorry, I can't pronounce the, was you? Okay. And he's a little bit more, he optimistic that maybe you'll have somewhere between 0.8 to maybe 1.2. And please look at the actual numbers, but somewhere around like 0.8 to 1.2, that was my rounding.
1% more GDP growth than without it?
Than without AI. So the AI will
But
contribute to this.
that's huge.
Exactly. And his point on this paper, it's a 24 paper, it's a working paper, is that other measures had said that they could be very close to 0. And he
There was
was
an MIT book, wasn't there, about that was going to be near 0, one MIT professor. But since then, he sort of recanted a bit from
right.
from his position. But do you, I mean, this I don't want to.
And this is just for the
you're
US.
making an excellent point, but I mean, the CBO, when it does its debt to GDP projections, keeps 1.8 and doesn't. So the Republicans forced it to do a 0.5% higher. And the debt to GDP totally flattens out. The 0.5% higher.
Yeah.
I mean, that's how much a difference that can make. And so it's a huge issue.
It is a huge issue. And that's why I
not,
wonder.
Not a minor issue at all. And if firms can, get to 1% more, now there's going to be competition because if everyone does, it doesn't necessarily mean market value will always go up by that amount. We're both believe in competition, Rob. But in the meantime, you can scoop a lot out, right? Perhaps.
Hang on,
Right.
you're going in dangerous territory. Yeah. There's a question as whether the country or the world will be better off as a result of using new technology, and whether investment people can make clever decisions that will make them wealthier by allowing.
But who's
AI to
here?
assist
I mean, Elroy, who do you think's in this room?
Well,
The
These are
world
the- these are-
laborers or the investment
these are the
deciders?
current and the future asset managers.
Yeah.
And the prospects of them being able to tell their AI that they want a trading system that will select mispriced assets and it should work out of sample.
not
So
saying-
will they please take account of that?
Is that the
That's,
question?
that won't happen.
That wasn't what was asked.
Well, despite the fact that I'm optimistic about the market, apparently more than anybody here in the room, um, I think that from an AI perspective, it's a lot like the 1990s, and we probably have a few more.
What, 96 or 99?
Well,
Doesn't tell me anything. I'm sorry, Roger.
I don't know. That's the problem. We can it could definitely be 96.
Oh, 96, party on, guys.
But but ultimately, what the problem with the internet was that it really did impact our lives a great deal. But it took a long time to convert that into actually making profits for companies. And and AI, I think, is going to have a lot of the same issues here. It's not. It's hard to convert into profits. And we're not seeing too much in the way of profits in any of these AI investments. Yeah, and I don't know how long that'll take.
So I have a, I'm gonna step back to doing something really simple and trivial.
Okay.
And that is that I took the data by industries from the pharma and French industries, and then went back to the coals industries, of which there were 68 over the period of the coals period. And so then the issue was, how terrified should I be about a catastrophic crash of the industry that we're facing now? The question that we're all looking at is, well, we could be forecasting future returns, but we could also be thinking, should I sell out now? Should my clients sell out now? How panicky should I be? You take every instance from those two samples, and this is work with Otto, and Otto and I have been working very closely on both of those two samples because they're in two different parts of the U.S. capital market history and industrial history. And so we take this very large sample, we say, okay, let's just look at the cases where an industry has gone up by 100% in 1 year. And we could do it to 3 years too. So something that would terrify many people. And then also cases where it's dropped in half. So let's look at the extremes because that's what we're interested in. The remarkable thing that that comes out of this is, well, maybe it's not remarkable to people who are thinking about the equity premium, is that when you go 3 years out, there's really very little difference between the two. Now, there is some evidence in the later, in both samples, by the way, of a kind of a peaking of the ones that did very well and flattening out, but it's not dramatic. So, and we're talking about, hundreds of cases where this has happened. And the two time periods looked very much like each other. So that gives me a little bit of hope that, the idea of focusing on the 90s, I agree, it looks a lot like the 90s. And me personally, it looks like the 1720, which was the South Sea bubble, when a whole bunch of tech companies and so forth all started to raise capital in the London market. It's easy to focus on these episodes in history because we can learn from them. But I think once you start looking at the statistical evidence, it's hard to convince yourself that there is a high probability of an imminent crash when something has doubled in value. Now, that doesn't mean that once it does crash, you come back and say, well, I shouldn't have listened to Will Gutzman. But anyway, that's the experiment that we've
But
done.
the word bubble, as I said, is the most overused word of financial reporters as well as analysts. I mean, I remember, wasn't it Fisher Black who gave a presidential address to the American Finance Association, was asked what was an efficient price. And he said, he shocked people by saying an efficient price was anything from being twice what it should be to being above twice or less than half. That was his statement.
Hedge fund man.
What? Well, no, I mean, and that was his, he was asked, you believe in an efficient market. What's an efficient price? Anything, more than twice what true value or less than half.
So now people are using bubbles for anything that's 10% over what they think it should be, which is total, ridiculous. I mean, if efficiency is defined as a 2-to-1 ratio, bubbles should be like a 5-to-1 ratio or something like that.
In 2018, I came up with what I thought was a workable definition for the term bubble that could be used in real time. I mean, anybody looks back on the dot-com bubble and says, yeah, it was a bubble. Okay, that's blessings of hindsight. Identifying at the time as a bubble is more useful. And that definition was very, very simple. If you want to use share price should be net present value of future profits distributed to the shareholder in the decades that lie ahead. If you have to use implausible growth assumptions, not impossible, but implausible, to justify today's price, then it's probably a bubble. And if the marginal buyer of the stock doesn't care about valuation models, then it is a bubble. Using that definition, I would look at Palantir and I'd say, yep, bubble. And I would look at Apple and say, nope, not a bubble.
But Rob, how do you take the fact, as I mentioned in my talk, that from the peak of NASDAQ in March of 2000 at 5,000 to the 23,000 we have today is a 7% plus return? No, I'm just saying.
Long bond. Jeremy,
No, it wouldn't. I'm just.
Jeremy, you're looking at peak to peak, and
You are calling a peak here, okay?
I think we're closer to a peak than not. You're looking at the same dividend yield, let's say, 0.5% in both cases. Now let me finish.
Okay. I'm not.
6.5% return. Long strips at that time had a yield of 6. So you've got a 0.5% risk premium, even with the Mag 7, which are magnificent. Yes.
In fact, that's what there was a negative risk premium for the market as a whole, probably at that time. I mean, you're right.
Relative.
You were right because we had
Yes.
we had a PE ratio of 30 for the S&P, which is 3.3, and you're right. We had a 4.3% tips. 10-year tips.
Correct.
In March of 2000.
Correct.
Which is crazy to be higher than the earnings yield on the stock market.
Correct.
Totally crazy.
Yeah.
So can I just pick up with Elroy? Because this has been a lot focused on the US, right? But AI has the power, I think, of democratizing investment globally. And what do I mean by that? I mean, I grew up in Portugal. In Portugal, us investing in stocks was unheard of. Like, the average person would not invest in stocks. And it would be like, you would always be taught, like, you're going to lose your money. Like, you invest in government bonds. That was the mentality. And while things have changed over time, the reality is that in other markets, there's still this fear, this risk aversion, right, to invest in stocks. If you have AI, and here's my link, if everybody starts thinking, no, AI is the thing that will really improve equity returns across the board, across the world, if you create new demand by local investors to invest in stocks, you could see a rise up, meaning you could see equity returns not just in the not US, but like other geographies that you could see equity returns rise. Relative to the history that you've been seeing, Elroy, of like going down, just because this is a game changer, does the risk aversion, I'm not a fan of behavioral finance, but I have to say, it is. I mean, I lived it. People did not want to invest in stocks. And now my mom is investing in some indices that have stocks in them. And she was like, I didn't know there were stocks in them. I think I need to move out. So I'm just saying, if you have more people thinking that AI is going to bring, it's the water rising for everyone, maybe you have more demand for stocks overall, and that might improve, at least for some years, equity returns. So I was hoping to get Elroy's take on that.
Let me give you a historically driven narrative on selecting companies, selecting stocks. I think it would still work today. It's just a few years ago, Paul Marsh and I realized we're at retirement age. And so we got interested in the age of companies. And so what we did was, starting right at the beginning of our database, divided all companies into the children, is what were ones up to a certain age since the company was started, and then the teenagers, and then the more mature people, and then the elderly people. And so we had 4 hypothetical mutual funds, and they had similar numbers of constituents. Every year we'd move forward. Some of the children would become teenagers, and some of the old people would be dead. But we changed the composition, so it was an active management process, but mechanical. Who won? Well, it's the old people, the ones that got wealthy. The children, this is going to be consistent with your analysis of S&P constituents. The children, that is, companies that were formed only a few years ago, were the losers. This was a very effective method of picking, and much more effective than deciding whether you were in a bubble or not. It was mechanical, but there's a very, very big contrast in performance. We thought we might sort of move on to doing a sort of publishable paper on this, but we put it into our yearbook and shared it. But I'm still very struck by that, and that if you were following that kind of strategy now, then you'd be worrying about some of the Mag 7 no longer being children. They're teenagers. They're getting big. So the changing structure, I think, is intriguing, and the old established companies are the ones which, over the very long term, were values. They were value stocks. They weren't valued very highly, and they performed the best. So just a curiosity.
How would you call like Microsoft that has been around since the 80s, or Apple?
We did it entirely mechanically. So this was based on the London Business School share price database. We know for every company when it was formed. Our rules for a company that was formed a while ago focused just on the name that survived, not companies that were acquired.
Right, but now they're starting to be over 40 years old,
Yeah,
right? These types of companies. So I was just wondering.
So they, on that basis, may be destined to have a period of underperformance.
So if I could just jump on your note, Elroy, I think if we focus on the people in the room, and I assume many of you are either already are investment managers or are aspiring to be, or your financial advisors, I think one sort of overlooked generalized fact is that, the rise of index funds has meant that your clients can do just fine without you for, 3 basis points. So there's enormous pressure on people who manage money for other people to come up with something, anything, that sounds as if it can outperform. And in decades past, we had story stocks, and now we have story factors. And I think the real challenge is to sort of find some basis for intellectual honesty before you jump on the next bandwagon. And that's not a trivial challenge.
Yeah, and I think that the benchmarks and so forth have gotten better and better, and so it's in the old days, if the market went up, we were all smart.
Still true.
But with these, everybody has nowadays very tightly controlled benchmarks, and it's really you have to really actually have to outperform or outperform. And this is getting much
Well,
more difficult.
So, Elroy, are you planning to launch an ETF on?
On your methodology.
Company maturity.
Forget writing a paper. Launch an ETF.
Yeah. Before you, I would, I'm often asked, you're talking about role of financial advisors. This is in my opinion, the most important role of financial advisors, not picking stocks, not picking indices. It is keeping people in stocks during bear markets. The worst thing, you get people who only do Vanguard S&P 500 index. They underperform like 3% a year from the index they're in. Why? Because they try to time the index. Because they have nothing else to do because they're committed to the index. So, how am I going to show how smart I am? I'm going to get out when I think it's going to go down and in when I think it's going to go up. And how do you think that works?
Buy high, sell low.
No. And as a result, I often tell, a lot of advisors, if you can keep your clients in stocks when times get rough, you've earned your badge and you've earned your money and you've earned your fee.
Let me add to that. You can do that in the US much more readily than in the UK because continuation commissions are acceptable here. A financial advisor can have a panel of stocks, and if clients stay with the recommended portfolio, there's still some compensation for the advisor. Britain decided a good decade ago that was a bad idea and that you had to either commit as an advisor to one manufacturer of products or you had to be whole market. And there's a reduction in the level of hand-holding. There's no reward for managers in Britain doing what you would regard as sensible American counterparts being able to do.
All right. I want to take the focus. We've spent a lot of time today focusing on historical data and the past. We have a question here about how should people in the audience, and we've talked about it a little bit now, but how can people apply the knowledge they've gotten here today from this esteemed group to the future? And what do you want to share with portfolio managers and CFA Institute members or charter holders about how to take all of the synthesized knowledge that we've talked about today into their future management? Ed, you've been very quiet, so
The
start with you.
the takeaway that I would suggest is, again, never extrapolate. Okay, that's a bad use of history. The thing to take away from history is the range and the variability, how different things could be. There was no one, I wager, in 2007 who said, well, look, we had a 50% decline in 1999 after 1999. That was 26 years after the last 50% decline. No way can the market go down 50% again so soon. Well, now that's our history, and we know you can have fairly adjacent 50% declines in the market. The notion that once upon a time, yeah, it was the gold standard era, yeah, it was often under conditions of deflation. The notion that sometimes, once upon a time, bonds beat stocks. Will it happen next year? Will it happen 10 years from now? No way to know. But it has happened in the past. And I think that it sort of protects you a little bit. If you remember that, it's a gamble. It's one that's worked out very well. Jeremy's given us those numbers there, just how much wealth has been created in stocks, but it isn't always that way.
I think
Ominous.
what I would say as a practitioner is the one thing that I know is that I'm going to be wrong, no matter what I say. We're trying to predict the future. We're looking at a crystal ball and we're trying to say what will be the equity risk premium in the future, for example. And so I like to think about it from a practical standpoint as a range. Can I get to a reasonable range based on things like history, based on things on what's happening right now on the ground, and what are expected to happen in the future that might change the economy or markets? Because I know that just because I said my recommendation is 5% on an arithmetic basis, that doesn't mean 10 years from now that's going to be the equity premium that will be realized. But if I have a range, I probably will be in the ballpark of what can we expect. So as a practitioner, first, the extrapolation, yes, it really depends on the starting point. As everybody saw, like when do you start means where you end is very different. But, I think it's helpful to know the history and think about what would be a good period that is long enough but reflective of what you could expect in the future. But I think that you're going to get it wrong. And so do you have a reasonable range in mind as opposed to the single one number? I know I'm going to be wrong if I just pick one single number.
Well, I can say that I made a forecast in 1976 for the next 25 years. And the key to these forecasts they're probabilistic. It's a whole probability distribution. It's not a single forecast. So yes, the range is there, but it doesn't mean you can't. There's nothing to be learned from history. It doesn't mean effectively we have to extrapolate to some extent in history, but recognize all the dispersion of events that can happen and have a wide range of outcomes.
On this topic of ranges, Harry Markowitz was well known for saying there's only one free lunch in investing, and that's diversification. Spot on. Spread your bets. Don't make overly concentrated bets. Late in his life, he amended that to say there's only two free lunches, diversification and long horizon mean reversion. Mean reversion is evident everywhere, whether it comes to rate of growth of earnings, cyclicality there, whether it comes to valuation multiples rising and falling. The valuation multiples at near all-time highs doesn't guarantee that they'll come down, but you sure as hell shouldn't be extrapolating that in shaping your expectations. And if you're placing a variety of bets in your portfolio, and most of them are contra the narrative in the marketplace that sets current prices, that is to say, the narrative, investing with the narrative is useless because it's already fully reflected in share prices. So if you take that narrative and find that it is betting that a particular trend where you're at the extreme end of a historical range will go further, if that's the narrative, betting against it is fine. Don't bet the ranch on any of this. Yes, I think the market's overpriced. Do I want to bet the ranch and take all my money out of stocks? Heavens no.
I think we react far too much to short-term volatility. I mean, it's exciting. I mean, CNBC feeds on it. They love it. More eyeballs watch when the market goes way down. They get more advertising revenue. They make a big deal of it. The market goes down 2%. It's the start of a bear market for them. I mean, and the public too. I mean, I've talked to advisors and once told me that I own treasury bonds because if the Dow goes down 2,000 points, the treasury bonds are going to go up 3. And so my client will call up and say, how we're doing. And I say, well, our equities isn't too good, but we're 2 points up on our treasury. Okay, fine. Forget about whether it's going to be a long-term drag on their portfolio or not. That they're not interested. They're not interested in that. The short-run focus is just enormous, and it's partly embedded in your psychology, I think. Maybe, you can, as I said, handhold. Hey, this is going to be a tough period for you. I'll hold your hand to stay in the market. You want to get out because it looks bad. But that psychology is really just embedded in you. And, it's something that if you are a long-term holder
You have to keep that focus, and you may need help, and you may need an advisor.
All right.
do that
Jeremy, I
help.
think you may get the last word today. I'm going to invite Allison. First, please join me in thanking this panel for an incredible afternoon.
Okay, well, hold on one minute. Some closing remarks. And thank you very much, Amy. Thank you for leading the panel. Oh, still going? Okay. Oh, all right. Thank you, and thank you, Amy, for leading the panel here. Just quick on CFA Institutes, because we talked briefly about the quarterly earnings. I just wanted to mention that we actually have surveyed our members who do support quarterly earnings, but we did this a few years ago, and we're going to be doing this again, so stay tuned. And my colleague Sandy Peters there is leading that, so she can raise her hand if you have any questions related to that, who's Senior Head of Policy at CFA Institute. So thank you all for joining us today and for contributing to such an energizing and insightful program. On behalf of the CFA Institute Research and Policy Center, I want to extend our appreciation to all of our speakers, our moderators, panelists, and for sharing their expertise, and to CFA Society New York for hosting and supporting today's event.